I'm Pierre Daillie.
I'm Mike Philbrick.
This is Raise Your Average. On today's episode, we're talking about how investors should be thinking about crypto in 2026, especially after what has felt like and been a long, painful stretch for anyone holding Bitcoin or anything in their world. Our guest is Matt Hougan, Chief Investment Officer at Bitwise Asset Management. He spends his days watching this market and talking to both professional advisors and individual investors, and his view is pretty clear. Yes, we are in a real crypto winter, but underneath the bad headlines, some of the most important parts of the ecosystem, like Bitcoin's role as digital hard money, stablecoins, and tokenization, are actually getting stronger. We're going to talk about where we are in the cycle, what the pros are watching that most retail investors ignore, and how to think about Bitcoin as a long-term store of value with a built-in call option on it becoming money. Mike, how you doing?
I'm good. How are you doing?
I'm good. I was just looking at Bitcoin and I
Sorry about that.
yeah.
God.
62, like it was sitting, I just looked at it a moment ago, it was at 61,999. And I thought, that's 50%. Like that's just a little bit over 50% off the highs that we saw last year. And I'm curious to know, whether this crypto winter Matt keeps talking about is something advisors should lean into as an opportunity or just simply ride it out on the sidelines. What's the right, I'm curious to see what Matt thinks is the right instinct for a typical practice.
Yeah, couldn't agree more. It's quite a different time than it was back in October and November of last year. And the funny thing is it's pretty typical for crypto to go through this type of scenario.
Hey, absolutely. But frankly, many tech stocks, many tech darlings have gone through this kind of winter that we're talking about today.
Yeah.
So, I'm just curious to see what Matt's footing is on it. I'd like to know. I'd like to know, how much attention are advisors paying to stablecoins and tokenization specifically versus just focusing on what's plain vanilla Bitcoin and Ethereum exposures. Like there's so much other stuff. I think I watched something, you were on BNN and you were talking about Solana for a moment.
Yeah.
Which was that, well, I found your remark interesting, which was that Solana was really, one of the architectural backbones where business is concerned, where, contracts and, the same way that in a similar fashion as what Ethereum is a little bit more interesting than just currency as a play.
Yeah. And I think the whole do-it-yourself investor, the DIY crowd, the retail swarm, I think, the funny thing with them is they're probably looking at things like what's going on in AI, and they're distracted by other shiny objects to some degree. So the retail swarm is certainly not there in full force at the moment. And pretty much across the board, it doesn't matter whether you're talking about Bitcoin or Solana or Ethereum. Great stories on Chainlink and how they're going to be required, stories like Tau. Then you've got things like Hyperliquid, right, which is becoming a dominant global offshore market and soon to be brought into the U.S. You got
this is the 24/7 trading.
Yeah, and over the
tokenized trading. Yeah.
Yeah, and then you've got the Genius Act and the various acts that are going through Congress, and you see those institutional. On the institutional side, things continue to, make progress. And on the tech side, they continue to make progress. So, one just wonders when the retail, magnifying glass gets reset to the world of crypto. And the other thing that I'm really interested to talk to Matt about is the agentic world. So as we get into the world of agentic AI, these AI task completers are not going to have bank accounts, and they're going to be doing autonomous work online. And how are they going to get paid since they're not banked? maybe the person who's running them possibly, but there's a lot of agentic work that fits extremely well into being operated on a blockchain and settling whatever claims one might have back and forth via the blockchain. And so to me, it's all coming together, but it's when does the heat come back to the area? So it'd be interesting to talk to Matt about all of that, where we are in that cycle, how he's talking with institutions and things like that.
Obviously the AI, rally that's going on, and we've had some volatility this past week, but it's ongoing volatility, but also, the SpaceX IPO and other IPOs that are in the pipeline sort of sucking the oxygen out of the market. I think it's always interesting, like when you see, like Bitcoin as the sort of bellwether, down 50%, it just feels like, oh, this is so bad. This is so bad. What are we going to do? Investors are, probably looking at it or I don't even want to talk to my clients about this right now because it's such a, black mark. But all this other stuff that you just talked about is actually ongoing work that's continuing, whether we like it or not.
Precisely.
Whether we believe in it or not.
This is Raise Your Average, dedicated to making you a better long-term investor. Join us as we sit down with some of the most interesting names in finance to discuss macro, markets, investment strategies, and more.
Hey, man. Hey, bud.
How's it going? What don't we believe in?
Oh, there's a long list.
We were just that is the book for sure. I'm just joking. I just parachuted in right at the end. How are you guys doing?
Yeah.
Great.
We were just rattling through some pre-show stuff and chatting about AI agentic work and how its impact could potentially have some pretty serious implications for the crypto world. And I don't think those things are being priced in at all at the moment, it would seem.
Yeah, I definitely agree with that for sure. What an interesting time to be alive.
Right, sure is.
Big a while.
That is an understatement of the century. We've got AI, we've got blockchain, we've got space. We're sending stuff to space. I mean, we're not at peak imagination yet, but we're working our way there.
We are getting there. Yeah, they're prospectus filings that talking about colonizing Mars. I mean, that's
what is it? A billion shares if he gets 1 million people settled on Mars?
That's right. Yeah, exactly. That's it's not in my KPIs yet, but
it's hard to.
I think Columbus got a similar deal.
Exactly.
It's not hard to imagine why investors, get pulled around and dragged around to the next shiny object, and then we've got so many to choose from, and some of them are just completely right out there fantastic still, and some of them are established. We were just saying, like, people look at Bitcoin and they think, wow, it's down. I was looking at the price, Matt. It's 61,999.
Yeah.
And when I looked at it a moment ago, which is just slightly over 50% off the high, the darling that fell from grace, like, for now, like.
Yeah. I mean,
right. But what we were saying, Matt, sorry, I don't mean to interrupt you, but what we were saying was that, many of the tech darlings have gone through this cycle before. Any of the Mag 7 stocks have gone through these routes where, they're down 50%, 60%. Meta was just, yeah.
Yeah, it's so true. I was thinking of posting like a guide to AI investors on what to do when the asset dips a few days ago. Because in crypto, we're so used to it. And, I think AI will have that moment. I guess it is today, right? The Korean memory stocks or whatever. Yesterday.
It's interesting that SpaceX gave back half of the total market capitalization of Bitcoin in what, 2 days?
It does put it all in perspective. And more than the entirety of everything crypto x Bitcoin.
Yes.
The whole part of crypto that's supposed to reinvent all of finance is
Yeah.
less than 1 day of trading in SpaceX. It is.
Well, Elon knows. He's like, I'm not going to go down like some sucker like Christopher Columbus and not get my equity share when I colonize the next planetary, geography. And
That's right.
make sure he's sad. He took Christopher Columbus's, he looked at his deal and he said, wait a second. I'm getting paid or I colonize Mars. It's too good. It's too rich almost.
It is.
And it's so great to have you on because it's going to be great to catch up on, what do you, well, I guess we should probably dive in, but as a high level.
Welcome, Matt.
Yeah. What
Thank
are
you.
you seeing? How's this winter different? Are you seeing the same sort of developmental cycle under the surface? It seems to me like, things would probably be more bullish than they were a year ago from the perspective of where we are from a legislative perspective, what agentic AI could bring to the table for tokenized transactions, the position of many institutions and whether they have a holding or don't. I mean, it seems all quite fundamentally quite good. The price just sucks.
I think you nailed it on the head. Look, I think this is the best winter ever. This is like a global warming winter for crypto. The price is down, but it's down less than previous winters, right? Previous winters were 70 to 80% down, and this one is 50. Volatility is lower. We have a much better regulatory environment. We don't have the same blowups we had in past winters, right? Remember last winter was FTX, 3 Arrows Capital, etc. The winter before was the ICO crackdown with all the scams. The winter before that was Mt. Gox, the largest custodian, collapsing. Right now, maybe there's some like small boogeyman out there, but there's been no existential collapse. And at the same time, we have all the things that crypto was talking about for years actually happening, right? We have people reinventing trading. We have people reinventing options. We have people reinventing reinsurance. We have real world adoption of stablecoins. We have BlackRock and Goldman and others building on blockchain. So I think, the people who are sad about this winter are like the people who want more pain. They're the people who are taking cold showers in the morning because it's brutal. Or they're the people who liked a band before it was popular and now they're charting and they're like, this is over. I think it's a great setup. I'm hugely optimistic for where we're going. It's the best winter ever. You can see the spring coming. So the price sucks for sure. And the vibes on crypto Twitter are down. But I think we can see what spring and indeed the next summer looks like. And I think it's pretty bright.
And these are the opportunities, right? When you're thinking through your allocation methodology, we have some products that have some Bitcoin exposure in it. And we're constantly suggesting to people, you got to crawl, walk, run, right? If you're going to get a position that's small that you can defend. And if you did that and you have some inopportune purchases, well, now's the time to be defending. Now's the time to be looking at that position sizing. If it was 1 or 2 or 5%, topping that back up to where it was before and letting the market volatility work for you. Now, when we come out of the winter, which we eventually likely will, even Peter Schiff says Bitcoin isn't going to zero now. So, I mean, we've got one convert. So as we kind of progress and come out of the winter, I mean, these are the times where it's a little bit frustrating and boring. It's like paint drying. But, these are the exposures that when you look back a year or two from now, you'll be happy that you put up with the next, who knows how long it'll be, 3 to 6 months of 3 to 6 weeks. We really don't know how long the sideways action continues, and you build a base and all of a sudden you bid from there. And then if you've got that, those harder purchases under your belt, as you go from crawl to walk, you've got a lower cost base. Your position can grow into that allocation. You may not have to add. You could sin a little by not adding as it goes up and maybe letting it grow a bit in your portfolio. But now are the times to do that. And we're seeing trickles of it, I have to say. I still see some creates coming through, which are great.
Yep.
But what are you seeing in that regard? Are you still seeing sort of the old, is the old sort of guard that was sort of working its way through the process, going through all the chat, like, the committees and the investment side and the institutional side, those are operating at quarterly kind of, board meeting-esque type timeframes. Are you seeing all that continue to progress as well?
Yeah, actually, I love the point you're making. It's exactly right. People always ask me, Matt, you're always bullish on Bitcoin. How can that be? I'm like, well, I've been at Bitwise for 8+ years now. Bitcoin is up roughly 10x since I started. That's like a pretty good track record. Now, during that 10x, it's had multiple 50, 70% pullbacks, but you have to be allocating for the long time. So I completely agree with you. In terms of what we're seeing from adoption perspective, it's actually really distinct. I've said before that the average, client that we serve, which is a financial professional, right? It's financial advisors, it's family offices, it's sovereign wealth funds, et cetera. They take about 8 meetings with us before they allocate, because there's a long learning process. They have to get very confident and then they allocate. What we've seen since the pullback started is that those who got over the line before the pullback started have used this to build their position. So they have conviction, they're not selling, and they're the ones who you are creating those creates that you saw.
Right.
The thing that is also true, I won't just be Pollyanna here, is the people who got up to the line but not over are holding off. They want to see it bottom first, right? So it depends on if you're in or if you're out. If you're in, you're adding. If you're out, you're watching and asking, is this the bottom? Is this the bottom? Is this the bottom? That's the behavior that we're seeing in the market.
But those behaviors are at odds with each other, right? I mean, those, like,
Yeah.
the first makes a lot of sense. Like, if you believed in it last year at 100, at 100 to 125, what changed between then and now fundamentally?
And fundamentally, you didn't get over the line and get the purchases in, and now it just goes down, and you're not going to talk to your board about that. The career risk is real. I mean, we're in a classic scenario. I think it's behavioral, but back to you, Pierre. Keep going.
But people always say things like, if it drops, I'm going to buy. I'm going to back up the truck, and then when it actually happens,
They're lying,
right?
Those are called lies.
Yeah. I tell people that they need to look. The issue is that when you say that, when the market is up, the market feels good. So you're like, of course I would buy if it drops to this level. But when it gets to that level, it's not going to feel good. I tell people to take a sticky note and write down the price at which they'll buy Bitcoin and put it on your laptop. Because I promise you, like right now, it's at 62. If it gets to 55, it's going to feel awful in Bitcoin land. So if 55 is the number you'll buy at, you need to have a forcing mechanism that tells you you're actually going to allocate at that point. But it's hard. It is behavioral, as Mike said. I think that's the reason we're seeing this activity is classic sort of behavioral ties.
There's a lot of focus on.
We've seen this in every asset class under the sun, right? I mean, this is hard. It really is hard. So, but like, that's why I think it's so important is get off of a zero, right? Get that de minimis amount in where you can you're okay with it. You're okay to defend it, right? You put in 1%, it's now 0.5%. That was, 50 basis points of your portfolio. Let's go put the other 50 basis points in.
Yeah.
And let's just, and maybe it goes down to 40. Like we don't know, whether you're talking about Bitcoin as scarce asset or you're talking about some of the more operationally slanted cryptos like Ethereum or Solana or Tau or Chainlink. I mean, all of these things have such what seem to be incredibly exciting futures, especially when you start to factor in the agentic world.
Yeah.
Manage your behavior, right? Just manage your behavior. I like the idea of taking a boggle approach, buy the market cap, don't even worry about it, have your 1% in, close your eyes for 10 years and see what happens.
But that's not how, that's not how most investors function is, with this systematic, that's the whole point of all these systematic solutions, right? Is to help investors overcome their own behavioral, blockades and things that we say we're going to do, and then when the opportunity presents itself, we're not ready. Emotionally, we're not ready. We may have the capital to put into Bitcoin at 62, but we're just not, the fortitude's not there. So the systematic programs are so important.
So the funny thing is, Matt's talking about institutions that took 8 meetings to get there.
Yeah.
And the dudes and gals who got there are like, yeah, let's do it. The ones that are sitting at the precipice are like, I'm not touching that. Too much career risk. Why would I want to go explain this to the board? I'll wait for it to bottom. Like we're in that classic bottoming phase where the people who aren't in are like this, hands off, sitting back.
That's exactly right. Yeah, they're all humans at the end. I also think there are a few things that come to mind. The first, getting people over the hump. One thing to recognize is that this is, to speak to the Jack Bogle thing, this is part of the world's capital markets. Like equities are 110 trillion, crypto's a little under 2 trillion. The neutral position isn't actually zero. I try to get people to realize this. The neutral position is somewhere in the 1% to 2% range. If you don't have an opinion, that's where you should be. If you're bullish, you should be over. If you're bearish, you should be under. But if you don't have an opinion, that's where you need to start. But I do think there is this behavioral quirk. I also think there's something strange about crypto that I don't see with other assets, where people think that if they allocate 1%, it could somehow destroy their entire portfolio. When the math tells you that if you allocate 1%, you can lose 1%. And I don't know what that is, but people think of it as this like virus that gets into their portfolio. But no, it's part of the world's capital assets. I think it's a very exciting part with significant upside. I think the right position is not zero. And yeah, systematic strategies can help people allocate.
It's kind of an all or nothing thing, isn't it? Like, it's not like you're absolutely right.
It really isn't an all or nothing.
I know it's not an all, but that's how how people view it. Emotionally, that's what it is, right? So but you're right, Matt. No one's going to get a black eye from 1% of their portfolio being in Bitcoin.
It's going to be fine, and in fact, it scratches an itch for people that sort of solves that behavioral issue. So a disciplined approach, not chasing highs or panicking at the lows. And it sounds like every other asset, because in a sense it is like every other asset, right? It needs to be disciplined and thoughtful and long-term oriented. That's true in crypto as well.
You think if Bitcoin had some income, it would be treated better? I mean, I'm not talking about options-based income, but it's like, gold gets the same treatment as well because it has no business, right? There's nothing behind it except for the thing itself.
Yeah, I think that's a challenge for some people, certainly for the discounted cash flow people. I think that's a mental challenge for them to overcome. But yeah, there are lots of assets that don't generate cash flow that have significant income, and gold has a strong track record of doing that. It's also part of what gives it its low correlation to other assets, the fact that it's different, which is part of what makes it such a good addition to portfolios. So there is a two-edged sword to this income side. But you're right that there is no fundamental floor that people can point to. And I think that's a challenge for some people.
It's a function of Pierre of scarcity, right? Yeah. So when you have an asset that's scarce, that's a feature. It's not a bug, right? A scarce asset means that there's like waterfront property. Gold is a scarce asset. Bitcoin, there'll be only, the 21 million coins. And that scarcity is what drives the uniqueness. The fact that it doesn't have cash flows and cannot be easily replicated is the feature, right? It is the thing that you're actually looking for. And it's also kind of not all that surprising that when you're looking at scarce assets, the other, the granddaddy of them all, scarce assets, is going through a bit of a consolidation period from having a blow off top. Maybe it's not a blow off top. It had a good run, and now we're digesting those gains. And so, when you're thinking through the different layers of the digital universe, that's something to think through. Am I looking for scarce assets that are gold-like for that 1% to 2%? Or am I looking for more technology assets that have a function that, in my mind, is going to explode to the upside with respect to AI coming into Right. So I wonder, Matt, if we don't just take a moment and step back, because you do such a good job of explaining this. Maybe some folks are, watching this and don't have an idea of the different types of technologies or digital assets that are around there. Maybe in plain English, you could walk us through that. And then on top of that, think through, where are investors sort of over-focusing, under-focusing in the moment today? Once you kind of, here's the landscape, here's what these things are and do, because you do such a great job of that. I can never do that as good a justice as you do. So,
Well, I
for the newbies.
That's kind of what we were talking about before you joined, Matt, which was that, people look at the price and they say, oh, this is so bad. This is so bad. This is the ugly duckling. What am I going to, why would I even, I'm not going to touch this thing. But they don't realize, and I'm talking about even people who have invested in it, obviously, the most people who have felt the most pain about it. But they don't realize that there's all this other technological work that's going on behind the scenes, developmental work, business, architectural foundations of a financial system that are happening, and they don't understand it, obviously, because they just haven't made the time to grasp all the different applications. But that's exactly what we were sort of chatting about as you joined.
Yeah, it's absolutely massive. And I agree, people lump them all in together, and they all think they're kind of like Bitcoin. Bitcoin is actually really the outlier. So blockchain is a new technology that allows value to be stored and move across the internet. You can do lots of things like that. Just like the internet was a new technology that allowed information to move across the internet. And you can use that for search or for shopping or for business or for video calls or for watching videos. You can use it for a lot of different reasons. And those are all very different businesses, right? That's Google, that's Amazon, that's Salesforce, that's Netflix, that's Zoom, very different businesses. Blockchain is the same. The first application was creating a version of digital gold, which is Bitcoin, and that has gold-like characteristics. But most of everything else, from Ethereum to Solana on down, is creating a platform that allows other traditional assets to move around the world and settle faster than they do in traditional rails. So by that, I mean stablecoins. Stablecoins are digital dollars that move over a blockchain-based network instead of over SWIFT or traditional payment systems. Tokenization are digital assets like stocks and bonds and commodities that move over blockchain networks like Ethereum and Solana instead of through the traditional brokerage system. And these new rails, these blockchain-based rails, are just much faster and much easier to use and much cheaper than traditional assets. I like to give a few examples here, so maybe it will hammer home. And then I'd be happy to explain why they're so fast. But just to give an example, if I wanted to wire money to the Philippines today, I could go to JP Morgan, which has 300,000 employees and a CEO that makes $40 million a year. And it would take 2 business days. There would be FX route in transit, and the fee would be $40. Or I could go to Ethereum, who has no CEO, no employees, no offices, and I could move it in a couple of seconds for a fee of a penny. That's like amazing, right? You have this thing that has no employees, no offices, no CEO that can move faster than JP Morgan. And the same is true on stocks. I could settle a stock on Ondo 24/7, 365 globally instantaneously, or I could use the traditional system where it settles in 24 to 36 hours. Right? These are just fundamentally faster. So the exciting thing about crypto is if you exclude Bitcoin, I think we're in the process of reinventing how money, stocks, bonds, and commodities move around the world on a very small part of the world, like on Ethereum, Solana, et cetera. All of those crypto assets, we were talking about this earlier, are like a couple $100 billion in market value. And they are fundamentally rewiring how all stocks, all bonds, all dollars move around the world. I don't think the traditional financial system is going to exist in the same way in the next 5 or 10 years. It's all being rebuilt on crypto-based rails. And people are completely missing that part of the story because they're distracted by price.
And how do you participate in I mean, do you participate in those situations, those opportunities through the coins, or do you participate in it through the companies that are innovating?
So both is the answer.
Right.
I'll take both sides.
Okay.
So every time a stock or a bond or stablecoin moves over a network like Ethereum or Solana, you have to pay a small fee. Now the fee is very small. It's like a penny, but those pennies can add up. They're used to buy back the underlying asset. So it creates like a buyback-like mechanism, which drives the value of those assets higher. So you have something like Solana, which has a good chance of supporting a huge amount of the world's stablecoin and tokenization traffic. It's valued at something like $40 billion, but it could have substantial revenue as all of those assets move on there. And towards Mike's point earlier, when you add AI on top of that, which is far more likely to transact with digitally native assets than the traditional system, and is likely to do it at a scale that is, 10, 20, 30x bigger than we're doing today, you get a high amount of volume activity that can drive real value in those networks. At the same time, you have companies that are using these rails to reinvent traditional finance in a way that's cheaper, and they're doing extraordinarily well. You look at a publicly traded company like Figure, which is using blockchain-based rails to lower the cost of doing a HELOC from a few $1,000s to a few $100s. And they're eating market share. You look at something like a startup like which is using stablecoins and blockchain-based rails to reinvent reinsurance, and they're winning market share as well. So you can play it through the companies, you can play it through the tokens. I like to hold both in my portfolio because it's a relatively small universe, and why not have exposure to this?
You got sort of two different prongs. Well, four different prongs approach. You've got a scarce asset in Bitcoin. You've got assets that actually will have cash flows, all of which are, sort of valued at pretty low total market caps, if you will. And then, so what is it that is it just the empathy in the market currently that you're seeing as being the main sort of distraction from the allocations that might come through? Is it something else, or are we waiting for this legislative clarity still? Like, there are a few hanging chads, and they sort of say we're waiting for this, but it feels to me like we're just going through the normal course process of a bottoming of an asset that's gone through a correction. But what are you seeing otherwise? Is there anything else there that's
Yeah. It's a great question. I think it's mostly that. I think we're mostly going through a cyclical bottoming pattern that's happened before, right? Crypto has moved in these 4-year cycles, and till that stops happening, you should expect that to keep happening. It hasn't stopped happening. So it looks like it's going through that. This is a classic thing. I think the two other factors are, look, we have AI, which is like a black hole for capital that is taking capital from all other assets. So if you have a retail investor making a marginal decision, it's much easier to buy AI than it is to invest in this contrarian asset, which is crypto. And that's going to be true until it stops being true, but it won't be true forever. But I do think it is a black hole that's vacuuming up other assets. And then there's this third piece, which I've been thinking about a lot, which is a little bit of the boy who cried wolf is true for crypto, which is for the last 10 years, we've sat on the sidelines shouting, we're reinventing finance, we're reinventing finance. And then people would look underneath the hood and you'd be like, well, not really. There are no major companies doing this. And we did that for 10 consecutive years. And now it's true. Right now, Goldman Sachs has 200 people working on blockchain, and JP Morgan has a whole division, and BlackRock's largest fund is a crypto fund, and every major financial institution is building in this space, and the regulation is aligned, and the EU is approving stablecoins in Japan. Like, now it's actually all happening, but because we shouted it from the hilltops for 10 years, I think people are like, well, I don't believe you anymore. And so that makes it this thing where it has to get sort of overwhelming scale before people reevaluate it. So I do think part of it is the boy who cried wolf. For investors who can be fact-based, that's a real opportunity, because you can look at the stablecoin activity and see, wow, that is really reaching takeoff scale. You can look at remittances to Mexico and be like, wow, it's gone from 2 to 4 to 6 to 10% of all remittances done on stablecoins. You can look at what's going on tokenization and saying that's up 600% in the last 12 months. That's like really a big deal. But no one's paying attention because they've heard the story before and they've sort of dismissed it.
On top of that, you've got, what's his name? Is it Paul Armstrong, head of SEC? Is that
Paul Atkins? Yeah.
Atkins, yeah. I mean, you've got him saying, we're going to tokenize all stocks, bonds, money market. Like, we're going to do this. Not we're sort of going to do it. No, we're doing it. Not only that, but, we're having conversations with the National Securities Clearing Corporation about how we're going to adjust our trading. And we trade, ETFs and futures and derivatives because of what's happening with the digital reorganization and tokenization of all these securities. I'm like, this train is coming down the track. It's well articulated. It's it's in the forecast. They are doing it. The National Securities Clearing Corporation is going to operate on tokenized rails.
I love that you bring that up. Yeah. Just think about that. Think about the chair of the SEC saying all assets will be tokenized in the next handful of years. And the CEO of Goldman Sachs saying the same thing, and the CEO of BlackRock saying the same thing. Paul Atkins said this is the biggest update to our global financial system since we went from floor-based to digital trading. And the fourth biggest of all time. Like, this is a once-in-a-generation transition, and they're telegraphing it, and it's not reflected in prices. I think it's really a pretty extraordinary series of things. It makes me very excited. It does take time. There are a lot of regulations that have to change. We just saw the SEC propose pulling back from Reg NMS in certain ways in terms of the ordering. You have all these little details that have to happen, but they're all happening. And I think it's a tidal wave that's really going to catch some people off guard.
Yeah. How does it actually, like, when you talk to a lot of advisors, Matt, who are on board, and what's their reaction to that? Are they concerned? Are they excited? Are they happy about it? Are they wondering, like, what does this do to my business?
Well, all of that. Yes.
Yeah.
They're concerned because it's changing, as you guys know. They're excited about it because they feel like that they're on the cutting edge, and they desperately want to know what it will mean for their business, because that's core to what they do. And I do think, look, I'm bullish on the advisory business, but I do think it's going to change in many interesting ways. And specific to this, I think the digitization of assets, what we see in crypto is it changes how people use assets in some really interesting ways. You no longer have many assets sitting passive in portfolios. They're used as collateral in lots of interesting ways. So I think for the savvy advisor, it's a generational opportunity. For a stuck in the mud advisor, they're probably worried and they don't want it to change, right? But that's very similar to other transitions that we've seen in financial markets, where there'll be a group that gets it, they'll do extremely well, and there'll be a group that doesn't, which fades over time. I think that will be true here too.
That's by design. I think that's the science revolution, one death at a time. Right. And I'm not sure why, whether you're a boomer, whatever the generation is, doesn't even matter what the generation is. I just hear, well, when I was a kid or when I was younger, things were cheaper. And when I was younger, we, said, we can't even talk about a stamp to a proxy for inflation now, because there are no stamps. You don't mail anything anymore. Like, I mean, if we're gonna fight the technological revolution, let's just go back to the cave and heat the meat and give back our phones and our cars. And like, I don't understand how the human race cannot be always at the edge of innovation. But that's my proclivity.
Yeah.
As an Xer, our generation is kind of skewed that way a little bit. But there's lots of older folks that tend to want to fight this constant evolution, and I'm always kind of head tilted at it, because I'm like, what do you want to go back to horse and buggy? Like, what is that better?
Well, listen, as an Xer, we've seen it all, right? We've seen both the analog and the digital world. When we were, doing research as youngs,
Yeah.
we had to go to the library. We had to go and read books. You had to go and take notes and find the books on the shelves in the stacks. All right.
It's 100% right. I actually think it's why you see a lot of Gen X people and people from the ETF industry move into crypto, because they've seen this before. Like, they have seen new technologies met with skepticism. They've seen new technologies that are sometimes difficult to use. I remember looking up websites in a book. If you like, I'll remember. Okay, I've never even heard of that. It would quoting the thing. They would publish these directories of websites because there was no useful search. I remember doing it at college, and then you would type them in. So, but you see that digital tends to be inevitable. Ease of use tends to improve, and you can get major shifts over time. And the people who adapt to that tend to win, right? We all lived through ETFs taking over for mutual funds. Not everyone believed in that in the early 2000s, right? Some people said, no, I don't need it. I'll stick with mutual funds. And that didn't win out, right? This is the direction that technology goes. So I think we're all uniquely positioned to imagine how this plays out. Which was helpful.
First it's ridiculed, and it's violently opposed.
That's right.
And then it's self-evident. And it's crazy too, because as a use case, like, some people struggle with the use case, right? And say, okay, well, we're going to digitize stocks. But what does that do really? And it's like, no, you don't get it. You have total custody clarity.
Right.
You know the assets that you have. You know that they're not encumbered. You know they haven't been rehypothecated. And it gets better, right? What's the settlement? Why do we have T+? We have T+ because we have antiquated shit that we have to fix all the time over a day or two, and we need a day or two to fix it. So, you went through the Ethereum example earlier, or was Solana, doesn't matter which. But so you now have total custodial clarity. That's one thing that's great. But you've also taken away the settlement layer. So the velocity of money itself goes up almost infinitely, because you go from, a 1 to 5 day settlement, depending on if you're in the real estate world, sometimes even longer, to 30 seconds to 1 minute. And that is money that settles everywhere. It's not, I'm trying to send money to Malaysia and it's a Friday. And so my bank is going to close. Their bank's not even open until 3 days from now. Plus, I've got the 2-day bank settlement nonsense to go through. And so as a corporation, think about what that does. A light went on for me. We have a group in Cayman that does a lot of crypto, and one of their biggest clients is, in fact, a casino.
Mm-hmm.
The quintessential law of large numbers place. And, let's say you're a casino operator and you own some casinos in Macau and you own some casinos in Vegas. Now, you have to keep capital in both of those columns all the time, because you may have to pay out a big winner, which is a big loser to you. Mm-hmm. Even in your law of large numbers, you've got 5 casinos in Vegas and you've got 5 in Macau. It doesn't matter. Still, sometimes you get these big outlier events, and you have to keep capital to be able to pay those people domiciled in that area, because you can't move it from the big loser that was in Macau that paid you off in your law of large numbers. You can't get that money to Vegas for 3-4 days.
That's right.
Can't be done. But it can be done instantaneously over the blockchain. And so what these betting agencies or these casino operations have done is they've centralized the capital management into one digital place. Now they've taken all of those locations, all of that capital, and all of those different currencies, and they pulled it all together. And now they don't need 10 different pillars of money across 10 jurisdictions. They need one.
Yep.
They just became 90% more capital efficient. Those casinos are running at a much higher return on equity because of that. Now, that's a good example from a casino perspective, right? Okay, law of large numbers, we see how that works. But it doesn't matter. Your tire guy who's trying to pay for, Malaysian rubber, who's trying to ship it across the thing, has got the same challenges.
Yep.
And so all of a sudden, this 1 to 5 day settlement layer goes to 0.
Yep.
And then the velocity of money increases dramatically. there is no defaults on shit. It's because you have total clarity. And to me, I like looking at this going, I don't even know how the price is going down. And the funny thing, we're going to have to post this several more times because, given where we are in the cycle, there's probably our moms and our, maybe our lost brother who loves Bitcoin. Those are the 5 people that'll listen to this today.
But that's interesting, Mike. I think, the casino example you just gave, I mean, you can see how you could take that and apply it to the financial system, to, trading markets. While you were talking, I was just reflecting back on when, stocks were traded in fractions, sixteenths and eighths and quarters. I was remembering that and thinking, what did it feel like when it got decimalized, and now it has gotten fractionalized, not fractions like what I was saying earlier, but it has, the decimals have been reduced to, thousands, where now you can buy any quantity of stock for any, for $1 or $10 or 50 million, it doesn't matter.
Yep.
And we've gone through those transitions, right? But people are hanging on to this idea that I think there's like this skepticism about how, it's not real. It's the Matrix. It's but we're already in it. Like in that respect, already, like all these things they're already in place. They just haven't made the cross the bridge into the blockchain yet, right? And that
it's such a good example. The crazy thing is it's actually more real. I mean, if you take ownership of a stock in a blockchain-based system, you can actually own the stock. In the traditional system, you own a beneficial interest granted to you by Schwab for a paper certificate that's in seed and co that they've dematerialized. I mean, actually, if you get underneath the surface, it's this crazy fugazi of distributed ownership. And in a blockchain, you can just own it. I often like to tell people that if you just invert these objections, you see how crazy the existing world is. Like, imagine we were in a world where dollars settled instantly and someone was like, well, actually, we should build in a 2-day settlement delay. You'd be like, that's absurd, right? Or like that banks close and you can't move money on weekends. And someone's like, I have a new idea. We'll close on weekends and holidays and the world will work better. You'd be like, that's insane. So often when you invert these situations, you realize how unusual the existing system is and how inevitable this new system is, for the casino-like example that you gave, Mike.
This is the thing. It's inevitable. We're talking about capital markets. Capital markets don't F around. When there's better ways to do things, they're going to do the better way. Bitcoin has survived every death knell. They've tried to kill it multiple times. They've tried to kill tokenization multiple times. It's not dying because it's legitimately a better way to actually do all of the things we're doing. And we have to go through the process of people dying that did it the old way, that have all the vested interests, that have all the lobby interests. You're seeing the negotiation between the stablecoins and the banks.
Yeah.
And I'm like, oh my God, could there be a more obvious lobby against the consumer? Like, I don't understand. Okay, we don't want to pay interest on bank accounts, and so you can't pay interest on stablecoins. That's the most ridiculous consumer protection stance I've ever heard. But that's a very strong lobby. There's a lot of people, a lot of generations that have been, and you need sovereign nations needed some sort of banking, and so there's a lot to that whole conversation. But again, when something is superior and it functions in the way it's functioning, in capitalism, it kind of becomes inevitable. I mean, unless something else can come in and
that's right,
and create obsolescence for tokenization, I mean, I don't know what the AI world could do, but at this moment in time, gosh, this is just a better way to do everything.
Yeah, I think that's exactly right. Go ahead, Pierre.
I can't help thinking like that, we're looking at AI, for example, as this revolution. Maybe quantum is another revolution down the road when it comes to pass. But I don't think many of us are looking. I think those of us who know that the application layer of crypto and the rails and the system, the transformation we're talking about in the financial system is gigantic in scope, but we're not looking at it through the same lens as we look at AI.
Yeah.
But to your point, Matt, I mean, the one thing you said that was interesting was, distributed ownership. And you mentioned distributed ownership that, do you actually own the stock that you bought? Do you actually have it in your possession? And the answer is no, you don't. You just have a proxy for it or some signal on your computer that says you won't, this is set aside for you. But we have it in our system on your behalf, right? Yeah. So everything is on your behalf. But in the blockchain system, you actually can take possession of it.
Yeah. You
can actually put it on a digital wallet and bury it.
And it's clean and it's yours and you can use it as collateral. I think a good analogy to tie to the Gen X, I think it's like, the internet in 2003. You had the big level of excitement. You're in a sell-off. So people are skeptical of it, but people who know can see the power of the long-term technology, know it's going to be massively disruptive. I think that's true of this application layer of crypto as well. And I think that's a really unique opportunity, right? These are substantially marked down assets on a secular theme that is growing exceptionally fast. I mean, I encourage any listener to pull up a chart of tokenized asset. It looks, it's parabolic. It looks straight up. It's parabolic. Because it's just inherently faster, cheaper, better, more direct. It just is. That's why everyone's building on the space. That's why the SEC chair says all assets are going to be this way in 5 years. And, it's probably worth listening to him, right? He's the most important financial regulator in the world. There may be some truth into what he says. I do think that is an overlooked mega trend.
I'm just laughing about what Mike said now. That there's 5 people that are in
who buys this. It's episode. I've always you saw the guys at the compound and they were talking about, they had whatever Tom Lee on or something. Like, no one's going to listen to this. Everyone hates it, nor we talk about it.
Very funny.
It is the time. It is the time to talk about it. It's the time to be crawling.
How many people are
then running?
Yeah. How many people are actually paying? How many of us? Like, what percentage of people, even in the business, are paying attention to this?
Yeah,
they hear the rumbling, they hear the rumor mill, they hear the scuttlebutt, and all the skepticism all wrapped up together. But I have a feeling they just simply don't understand it. Not yet, anyway.
I think that's true. Well, they haven't felt it. Many of them haven't done it. I do think there's a visceral experience the first time you use one of these platforms. It's like, wow, that's incredible, right? The first time, I often show people Aave, which is a borrowing and lending protocol, and how you click 2 buttons and you're earning interest instantaneously. And, show them like literally in the next 30 seconds, we could be there, deposit money and be earning interest. Try doing that at your bank and then seeing the interest accrue. First of all, they don't pay interest. Second, if they do, it doesn't happen on a second by second basis. So I think part of the reason is they haven't experienced it viscerally, but they will soon, right? You're going to start to see this happen at an increasing rate.
I'm just thinking about the bank that we bank at for the company. Their commercial account has a direct wiring facility that we use, so we can wire funds to another bank right from our bank account. Mm-hmm. Directly. I'm not suggesting that's something that's still new, but when we started doing this, when we started using this bank, I think it was 10 years ago now, that was extraordinary. Otherwise, if you wanted to wire money to somebody, you had to go into the branch, you had to fill out a form, you had to do all this stuff manually, or at least tell the teller or the manager, the client manager, to do it for you. So when we suddenly had the ability to just go right into our own bank account and wire funds directly to another customer, to pay an invoice or something. That was so exciting to be able to do that instantly, right from, and not have to go to the bank and do all that manual stuff, right? So it's to your point, Matt, that once people have an experience with this decentralized finance application layer, whatever that experience is, their first time, it's hard to unsee it, and it's hard to go back. It's hard to think, I don't want to do it any other way.
Yeah, I think that's exactly right. And it's getting closer and closer, and you're seeing more integration. So more and more people will have that experience, whether it's moving money on a weekend or posting a stock as collateral and borrowing against it, which is extraordinarily challenging in traditional markets and extraordinarily easy in crypto markets. So I think people are going to have those experiences at an increasing pace.
My wife's actually written a set of children's books, and they all indirectly, not all, several of them indirectly deal with explaining tokenization. Matt, I'm going to send you these. So I'm going to get your address. Send me your address.
Yeah,
I'm going to send you these books because they're great from the standpoint of it's for kids, but it's also for adults.
oh, I love it. Can't wait. Yeah, everybody.
Absolutely. So the other funny thing in the sort of old system to new system, I got to go back and then I want you to dig in on some actual crypto layers. But I remember getting into this business in like the late 80s. That's how old I am, early 90s. And in the early part of my career, I had people come in with actual stock certificates.
Mm-hmm.
They had the bond coupons that they would clip. Like this is my, being an Xer, I actually have some analog history. Now, why did this silent/great generation have their stock certificates wrapped in tinfoil in their freezer? Anyone have an idea of why? It's called the Great Depression, where all the banks actually went under. And because they were rehypothecating assets at a very high rate, the banks went bust.
Mm-hmm.
And so the idea of custodial certainty for those generations was incredibly important.
Mm-hmm.
Fast forward 100 years since the Great Depression, and we've got this kind of, as we've outlined, somewhat fugazi, possibly ways in which we allocate, Schwab owns it, but the Central Clearing Corporation keeps most of it, and they just trade what everyone does every day. And, if your corporation holding those securities goes bankrupt and you think that, I have it in a cash account and my stuff is safe, that's actually untrue. Bankruptcy law takes over. Bankruptcy law has a different set of standards. And so when I hear that nonsense, I'm like, you haven't dug deeply enough. And we haven't had that earth-shattering event like a Great Depression where, actually owning the assets, having the physical certificates wrapped in tinfoil in your freezer was a way to have an actual custodial holding of your asset.
Yeah.
It's funny how we're kind of coming full circle. Either you could own it on blockchain or have them deliver your certificates and put them in your freezer. So when your house burns down, if anyone doesn't know this, when your house burns down, actually what's in your freezer actually kind of survives half the time. So
Well, there you go.
that's why you put it there.
Yeah.
Hey, we came pretty close in 2000.
Yes.
In 2009.
2008, of course.
Yeah,
We did.
We came pretty close.
I'm wondering if we couldn't shift gears a little bit now, Matt, and let's kind of walk through in a little bit more detail. So we've talked a bit about Bitcoin. Mm-hmm. We've talked a little bit about Ethereum and transactions, but maybe let's go a little deeper for those who have been around crypto for a while. And let's start to talk about the intersection of tokenization and AI and agentic work and the different layers, right? How does Bitcoin play a role? What's Ethereum and Solana's role? Then what does something like Bittensor do or Tau? And how does Chainlink fit in? And, just the idea of proof of human, agentic work. Do you have a minute to kind of go through that and lay that out for us a little bit? Because you talk about this a lot, or I've seen you write about it a little bit too. And I think it would be helpful for some people to understand the sort of simultaneous layers between what's happening in tokenization and how that's complemented by what might be going on in the world of AI.
Yeah, absolutely. We're very early in this phase, but if you think of it big picture, if you imagine that the world is increasingly agentic and that AI-driven agents will be doing transactions on our behalf and on their own behalf, increasingly in complex ways into the future. So I think the probability of that is close to 100%, right? We're probably at 0.01% now, and it's going to be a huge part of our future. A few things are true from that, and then we'll get to crypto. The first, which I mentioned earlier, is that the scale of transaction activity is going to go through the roof because these agents will be able to transact 24/7, 365. They'll always be looking for optimizations in a way that you and I may look for an optimized flight once, but they will always be adjusting that. And there are an infinite number of varieties of those. So exponentially more applications, 24/7, 365 on a global basis. So that's the foundation. The reason people in crypto are excited about that is because you can ask yourself, is it more likely for an AI agent to walk to your bank and conduct a transaction or to interact with a software service using code? And the answer is they're more likely to interact with a software service using code, right? So most likely they're going to be using blockchain-based rails. Are they more likely to open a bank account or use stablecoins? They're more likely to use stablecoins. Are they more likely to hold physical gold or Bitcoin? They're more likely to hold physical gold. And so the 30,000-foot view is that the direction of finance is in an agentic angle, and that direction means digitally native, which means blockchain. That's the big picture view. In terms of where the stack goes, Bitcoin has sort of two plays on this that people get excited about. The first is the example I just gave you, which is if they're looking for a native non-fiat based asset, they're probably going to reach for Bitcoin and not gold. Now they may reach for tokenized gold, but chances are they'll reach for Bitcoin. The other angle is that if AI leads to real abundance, scarce assets are going to be more valuable than ever. Mike, you mentioned coastal real estate. That's probably a good investment in an abundant AI future. So probably is gold, and so probably is digital gold, which is Bitcoin. The more direct plays are the other things. So Ethereum, Solana, and other layer ones, which are the platforms on which these transactions take place. And you could think of them as toll roads. The more people who drive through the toll, the more transactions are paid, the higher the revenue and the higher the value of that toll road. The reason why AI is exciting is because instead of having, 5 billion humans on it, you could have 500 billion agents. And so the toll road's about to get more crowded. The transaction activity is about to get a lot higher. The revenue potential is significantly higher. That's great. And then you have these other plays that are related to it. You mentioned Chainlink. The right mental model for someone thinking about Chainlink is it's like the Bloomberg for blockchains. If you have a stock that's trading on Solana, Solana is like a spreadsheet. If you ask an Excel spreadsheet what the price of Tesla stock is, it doesn't know. You need a way to find out the price of Tesla stock. Chainlink is a link between a blockchain and the real world. It provides that kind of information. So to the extent that we have more real world assets interacting with blockchains, Chainlink is going to thrive because it is the service that dominates providing real world information. Now it does other things as well, but that's a big piece of what it does. And so I think that will do well as well. And then you get to more AI specific assets. So you mentioned Tau, which is the ticker for Bittensor, is a decentralized AI marketplace that makes inference and other things available on a decentralized basis. Some other assets in the space that are worth noting, you mentioned proof of human. World, or what used to be called WorldCoin, is an asset that was developed in part by Sam Altman that allows you to prove that you're a human and a unique human in a digital world. which could be increasingly valuable. But I think that's the 30,000 foot view. And there are a few more layers to it that people get interested, but those are some of the big picture layers. Bitcoin has digital scarcity in that world. Ethereum, Solana, and other L1s as the toll roads. Chainlink as an example of an information provider, and then AI-specific assets like Tau, like Venice, like WorldCoin, etc. Look, there'll be a moment where agentic finance is the hot thing in the world. The same way there's been a moment where like memory stocks were a hot thing, and NVIDIA was a hot thing, and SpaceX is a hot. There will be a moment where everyone is talking about agentic finance. And these are the assets that are going to benefit when that moment rolls around.
Love it. And it is somewhat, I mean, to some degree, it is inevitable. Like you say, this is the very early days of this journey. But, you know, as you lay out the future, I don't think it's going to be less digitized. I think it's probably going to be more digitized and more work 24/7 being done by autonomous agents in that world. So I think that's a very interesting angle longer term. If you can be a long-term investor, you know, for what that's worth.
It makes sense from the perspective that, you know, the three of us here are Gen X, and, you know, we can manage between both worlds, right? We're happy to do the analog stuff if we have to, because we can. And we're happy to do we're probably more happy to do the digital stuff because we can. But we can do both. But how many generations, what generations that come, you know, our contemporaries come after us can? if they have, you know, if they're digital natives, then you're right. The odds that digital will increase is all but certain.
It's
right?
almost infinite.
Yeah.
And there's actually another a demographic important thing underpinning this. Which is, you know, 10 years from now, the person who's a managing director at Goldman Sachs grew up in a tokenization native world, right? Today, that person is a Gen Xer and they've seen both sides, and so they're weighing things. But 10 years from now, the choice of tokenized world or non-tokenized world is going to be a no-brainer. The analogy I make is, again, to the ETF space. We all saw this in ETFs. The people who were early in ETFs are now leading the asset managers across the world. And so they're all defaulting to build in ETFs. The same demographic trend is pushing this as well.
And so where does that leave? Okay, we come back to, let's talk about, you know, rubber hits the road. You know, most of our target market for you and us is registered investment advisors. And so they're processing this. Both of them have listened to this podcast. And we just the other two. Yeah, what are the I'm teasing, of course. But what are the takeaways? What can we've talked about a lot, but we have these advisors. They're talking about these assets with clients. I'll give a plug for Return Stack on the side of things. We've got an advisor guide to client conversations around Bitcoin and gold. So if you want something like that, it's helpful. It's not product oriented at all. It is oriented towards, here's how you have these discussions with clients. So I'll point that as a small resource. I think Bitwise and yourself, Matt, you guys have just a lot of really good supporting evidence, whether it's, the add 2% to the portfolio, how does it change the portfolio, all those types of things. And so there's an educational element, and maybe you can walk through what are the key components that you're seeing used with success today as advisors are going out and talking with clients at this opportune time to start thinking about this. Because honestly, you go back to October of last year, that's probably, you got to know that you're in the SpaceX moment when you're starting your allocation. I mean, a little bit. Had to be niggling at you a little bit.
For sure.
So now you're in a bit of a winter where you can start accumulating over time, slowly, gracefully, not making it too big, but you have an opportunity here. So how do we help move those advisors to help move those clients in a direction that might be helpful for their longer term returns and balance in their portfolio?
Yeah, I love the question. I mean, I would say two things, which we've touched on here. The first is a reminder that it's part of the capital market, right? Again, I go back to equities are 110 trillion, crypto is 2. So the neutral position is not zero. It should be, the neutral position is in the 1% to 2% range, and then you can be bullish or bearish from that. But resetting on that view, I think, is important. The second thing I'll say, and then we'll talk about resources, is that this is a pretty unique moment in crypto. For most of crypto's history, the hype has been bigger than the reality. We're going to change all finance, and there's like $30 million of stablecoins, or all stocks will be tokenized, and the regulations haven't adapted to it. But actually, that situation is reversed now, where you have the chair of the SEC saying all assets will move on chain, and traditional investors are like covering their ears and covering their eyes and pretending it's not happening. That's a really exciting moment, where the fundamentals are way above the recent price trends. And I think there's a good case to be made that, if you have a diversified portfolio that doesn't hold crypto, you're missing one of the important mega trends that taking place, which is we're reinventing finance on chain. And maybe you want some exposure to that. I do think our two firms have really good resources, and consulting those resources, realizing that this is not going away. In fact, the largest financial institutions are increasingly building in this space. And maybe you want to have a small allocation, particularly at these low levels. I just think it's an extraordinarily attractive moment for people to, again, not put in 50% of your portfolio. We're not saying anything like that. Just that this has a place in portfolios, and that's a really exciting trend that's maybe underweighted by the market right now.
Is there any pieces in particular that you think would be quite helpful today? Advisors sitting there going, I see this down, but how am I going to have a conversation with my client on this? Much like the institutions, right? They got over the thing and they're like, well, we've done the 8 meetings, we've got to allocate. And when you're one short, you're like, I'm not doing anything. And I mean, I get the behavioral side of why, but how can we help those advisors move those clients in a direction that is in that, it moving off of zero, if you will, or rebalancing back up to target weight, or what are the resources that can help get them?
Yeah, I'll call out two at Bitwise. You mentioned our study, which looks at the role of crypto in a portfolio. I think that's really helpful. It demonstrates in part that even during markets where the price pulls back, having an allocation and rebalancing has actually boosted your risk-adjusted returns. So even in the thing you're worried about, which is the market selling off, because it's low correlated and you have a rebalancing tolerance, is actually helpful for a portfolio. And so I think that can give a lot of confidence. It demonstrates that there's never been a 3-year period in Bitcoin's history where adding it to a portfolio and rebalancing didn't boost your absolute and risk-adjusted returns. So there's a lot of data behind this allocation. Maybe you think this time is different, but unless this time is different, there's a lot of data that supports where you're going. The other, I'd point to a tool on our website too that's free, which is you can put in your personal portfolio and then add a small amount of crypto and rebalance it over any standard, any rebalancing tolerance, any period of time, and see how it would have done. So maybe a nice step is to take your actual, get out of the theoretical, take your actual portfolio and ask yourselves, well, what would it look like over the last 2 years with all the volatility we've seen? Go and do that. The last thing I'd shout out is I try to write a weekly memo. In practice, it's like 45 weeks of the year because I'm a human. But you can sign up for that as well, which is free. It's called the CIO memo at Bitwise. I make it short, like 800 words, because I know you have a lot going on, but it tries to talk about the biggest sort of thought that I'm having about the crypto market at any point in time.
Yeah, I highly recommend that to everybody.
Yeah.
Just to make sure you're on Matt's CIO Insight on the weekly. It is just great to keep you informed of what's going on. And I think also, getting a little drip of something, 500, 800 words will keep you updated. Keep one eye on that ball because, advisors have a lot of asset classes to look at. But I think, Matt, that weekly newsletter is fantastic. There's always a little bit of education in there. There's always a little bit of viewpoint, what's happening in the world. And it's a great way to drip on yourself for knowledge. So as you're an advisor trying to stay up with this field, as well as doing all the things that you would do as an advisor. This is a great way to just get a weekly check-in and see what research is coming out from Bitwise as well. You guys also have been very innovative on the product side. So I'm wondering if there's anything that you want to mention on that side that would be particularly interesting that you guys have got in the hopper. As I said, I kind of love the market cap idea, but I think you do have something like that, or I can't.
We do. We have
in that process. Maybe
it's funny you mentioned the product side. We have a lot of products. We launched some assets that I'm really excited about. Single asset funds on applications like Hyperliquid and things which are doing really well. My favorite product was our first product, which was the first crypto index fund, because it holds the 10 largest assets. It screens out assets like Dogecoin or assets with specific risks that we don't think are appropriate. But otherwise, it's just the market. And it's not right for everybody. But if you just want exposure to the market that updates, that's been managed, that has an 8-year track record, I think that index fund, BITW, it's my largest personal crypto holding. And I think it's a great place to start because at least you have exposure to the majors. And then you can tweak from there if you have specific views.
Yeah, if you're a efficient market hypothesis individual, then of course you wouldn't even have 0% allocation to Bitcoin. It would be in the or to digital assets. It would be, of course, it would be in the 1% to 2% range. I mean, if you're an efficient market hypothesis person, which many people proclaim to be, you'd also have global equities. But anyway, then you'd have a market cap weighting, and you'd let the market cap adjust. And I think that's a great bring Boggle to the party, right? It worked. It worked in U.S. equities. Maybe we can take some wisdom from that and say, let's let the market dictate what the allocation should be based on the capitalization. It's not a bad idea. If you're going to be like really parsimonious and say, what's the market cap? And then what's the market cap? What's the global market cap in asset classes? How should I allocate that? These market caps got a lot of good research behind that as well.
It does indeed. It does indeed.
And is that where they can find you at Bitwise, Matt? Yeah. Are there places they should look for you guys?
2 places. So go to bitwiseinvestments.com. Again, look for that CIO memo. We promise if you sign up for that, we don't send you other things. That's all you get. So we won't overwhelm you with marketing. If you sign up for the CIO memo, you get the weekly memo, and that's it. The other place to look for me is on X. I'm Matt_Hougan. If you're listening, my name has a U in it for reasons that aren't clear to anyone. It's Hougan. So it's Matt_Hougan. You can find me there.
Awesome. French heritage or something?
It's some Norwegian.
Maybe Norwegian. There we go.
I don't know, man.
I'm Viking.
Viking. Yeah, I made it easier to get, Hogan.com and all the URLs. So I guess there's a
hey, silver lining for that.
So Matt, thank you so much for joining us today. And I have to say you've reignited my enthusiasm.
That's beautiful to hear. That's beautiful to hear. Well, this was a huge amount of fun. You guys are always some of the most open-minded and thoughtful on this space in the advisor community. So thanks for having me.